Okay, everyone, we're going to look at our final chapter for this semester, plant assets, natural resources, and intangibles. So in this chapter, we're going to focus a lot on plant assets, how we compute the cost of them, how we calculate the expense amount of them, depreciation, for whole years or partial years. We're going to distinguish between what's called a revenue and a capital expenditure and how we account for them. We're not going to worry about the analytical, but in the procedural, we're going to look at how to calculate depreciation under 3 different methods. And then we're going to look at how we account for an asset disposal through discarding or selling it. So it's the whole range of an asset life. How much do we figure out its cost? While we own it and use it, how much do we expense it for? And ultimately, when we dispose of it, how do we record that information? I'm going to look a little bit at what's called a natural resource. The expensing of a natural resource is called depletion. The expensing of a plant asset is called depreciation. And then finally, we're going to talk about our final asset category for this semester, intangible assets, what they are and how we account for them. So let's look at our first learning objective, which is computing the cost of a plant asset. Now remember, plant assets by definition are tangible. You could see them, you could feel them. They're actively used in the operation. So it's not an asset you buy like a piece of land and it just sits there. You're using it. You have your building on it. You're using it as a parking lot. It's expected to benefit you in the future. So it's just not going to be used this year, but in future periods as well. And sometimes we call it property, plant, and equipment. There are 4 issues when it comes to property, plant, and equipment, or plant assets. And I already talked about them a little bit. The whole phase of its life: buying the asset, allocating costs to the periods you benefit from it, depreciation, subsequent expenditures you have after you buy the asset, and then ultimately disposing of it. So how do we determine the cost? Well, the rule is this. The purchase price of an asset, or the cost of an asset, is its purchase price and everything you have to spend to prepare the asset for its first use. So acquisition cost includes all normal and reasonable expenditures to get the asset in place and ready for its intended use. So for different types of assets, we're looking at different types of costs. Let's look at machinery and equipment, which is one of our tangible plant assets. The others being equipment, vehicles, furniture, buildings, and land. These are all plant assets. The purchase price of the machinery and equipment. Any extra taxes you have to pay, like sales taxes or an excise tax, to purchase the machinery or equipment. If you have to pay to have the machinery or equipment transported to you, add that in as well. If you have to insure it while it's being transported, that's also part of the cost of the machinery. Installing it, so if you have to pay, if you have any costs associated with installing the equipment or the machinery, assembling it, and testing it for the first time. So when you buy a piece of equipment, say to make coffee cups, you have raw materials, maybe it's plastic. The first time you put it in that machine, it's not going to spit out a perfect coffee cup for you. So you're going to have to test it and change settings on it and retest it. So until you get it in its first use, then all of those costs, including the ones we just talked about, are debited to the machinery and equipment when you pay for them. And that's the total cost of it. When it comes to buildings, it depends. If you purchase the building, the cost of the building. Title fees associated with the building. So if you have to pay to have the title transferred, if you have to pay an attorney to help you with the process of purchasing, an architect, that's not mentioned here. But if you have an architect, even when you purchase a existing building, you may do major renovations to get it ready for its intended use. Those are all debited to the building account. taxes, brokerage fees you may have to pay to purchase the building. What if you construct it? All the costs for materials, labor, and all other costs to get the building ready for its first use are debited to the building account. So those are some examples of additional amounts that may need to be added to the cost of the building to get the total cost. Land improvements. These are things like, and this is important that we designate what's a land improvement and what's land. Now in the real world, all these things people go, oh, that's improving the land, so I should debit the land account. But in accounting, no. Land improvement is an asset, a tangible asset that is on or in the land that will deteriorate over time. Parking lots, driveways, fences, walkways, shrubs, lighting systems, sprinkler systems. Okay, so a sign in the front of the building. All of these items are on or in the land and will deteriorate over time. We keep them separate from our land because these items are depreciated. Land is not. And there's land. Land is not depreciable, but it's very important when we determine its cost. The purchase price of the land. Title insurance premium. So if you're not familiar with what title insurance is, when you purchase a property, it has a title, proof of ownership. That's where it says, Lori Dunn owns this property. Well, when you're going to purchase land, you just don't buy it. Okay, because sometimes people have mortgages on that property, that land, or they may have liens on the property. Maybe they owe somebody money, like the government, or maybe a contractor or somebody, and the contractor or the government says, we're going to put a lien on that property. You're not paying us back. But when you sell that piece of land, we're going to get our money then when you sell that. So let's say I'm selling a piece of property, Lori Dunn selling a piece of property, 1 acre of land, and you're coming to buy it. What you're going to do is get the title, and you're going to have a title search done. And there's abstract companies that do title searches, or a lawyer will. And what they do is go to the county recorder of deeds office where the land is located. And this is all public information, so you could do this, but I don't advise it unless you're trained to do it. And you can search through all the records, all the title transfers, all the liens on properties, and you can find out who has a lien on this property. Is there a mortgage lien? Is there someone else you owe money to? Does the government have the lien on the property? Or is there anything weird about this property that the new buyer should know about? And then they'll come back to you and say, here's what we found. Now, let's say there's some liens on it. I have $15,000 in liens on this property. As long as I'm selling the property for at least $15,000, I'll be able to sell it to you. Then you'll receive the property free and clear of all liens. It's a clean title, we call it. Well, just in case that abstract company, that person that searched the title, missed a lien, we're going to put an insurance policy on that. And that's title insurance. You pay it one time, usually when you're purchasing the property, or if you have to refinance, because a new search will be done. And what that protects the buyer, that's you, from is if the abstract company missed a lien. That happens. It happened to me when I was purchasing my first property. Okay, my husband at the time and we went and bought this house. We were buying this house. And there was liens on it. Oh my goodness, probably over $120,000 in liens on it. And that's basically what we were buying the house for 20 years ago. So we bought it, and I think there was maybe $5,000 left over for the seller, for themselves. Well, here, there was a lien that was missed and the seller never said anything. It was for $10,000. With the title insurance on that title, the title company, the insurance company, would pay that lien off. If not, liens follow the property. They don't follow the person who made them. So I would have had to pay that off. So that's what it's protecting you against. So it was maybe $2,000 or $3,000, but it saved me $7,000. And that really did happen to me. It's happened to me a couple times with property. There was another time I owned property that someone claimed they owned some of my property and I stole it off them. So title insurance protects you from that. If you have a title search done and the title comes back free and clean and it's insured, any kind of future problems with that, you would refer the person to your title insurance company. They would have to pay that problem if they needed to, and you would still own your property. So we add that to the cost of the land. Property taxes you may have to pay from a prior owner. So if the seller's selling the property to you and they owe property taxes, those property taxes must be paid up to date before that land could transfer to your name. If you, as the buyer, pay those property taxes off, now that's part of the cost of the land. Once you own the land, property taxes are an expense to you when you pay them. But if you're paying them for somebody else, the seller just raised the cost of the land. If you have your land surveyed, the costs associated with surveying it are also added to the cost of the land. The title search itself and transfer fees. I know in Luzerne County, when you purchase or sell a piece of property, the transfer fee is 1% of the selling price. So I remember years ago, probably about 6 years ago now, I sold a property and I bought my property I'm in now. So when I sold the property, I sat there and I paid 1% of the selling price of the property. And then when I bought my new property, I had to pay 1% of what I was buying the property for. So it's a buyer and a seller fee. But if you're buying it, you add that to the cost of your land. And then if you have to pay real estate commissions when you're purchasing land. So these are just a sampling of some of the additional costs you may have to purchase land. They're all added to the land account. You debit the land. All right, so we saw land, we saw buildings, machinery, equipment, vehicles, and furniture are pretty much have the same kind of cost. We saw that graph, that bubble graph of all of those, and then land improvements. So those are your major categories of plant assets. Now in this slide, we're talking about what if you buy more than one plant asset for one price? How do you allocate the amounts, what you paid for it, between the assets you bought? And this is common right here, this example. So CarMax paid $90,000 cash to acquire a group of items consisting of land, land improvements, and a building. So they paid one amount, $90,000, to buy these three items. Now individually, okay, these items, if they were purchased separately, the land would have cost $30,000, the land improvements $10,000, and the building $60,000. But because they were bought in a package, you bought them for less, and that's normal. Okay, what are they doing to me here? 60 and 40. No, we're not putting the land improvements in with the land. I don't know why they're doing that on this slide. Give me a second. I'll be right back. I'm going to add a slide and come back and record. Okay, I'm back. It probably seems like I was gone for a second, but I was really gone for 5 minutes. So I created an additional slide because I don't agree with that prior slide's answer, because land improvements are depreciated. You must keep land and land improvement costs separate. So take a look at how we would allocate that $90,000 that they paid for the three assets. the first thing we would do is list each one by its fair market value. The building at a $60,000 fair market value, appraised value. The land had a $30,000 appraised value, fair market value, and the land improvements had a $10,000 appraised value. So if these assets were each sold separately, that's how much we would have bought them for, or a total of $100,000. But we didn't. We bought all three for $90,000. So what we do is allocate each asset's fair market value by the total of all the assets' fair market value. So 60,000 over 100,000 would give us 60%. So 60% of the amount we actually spent, 90,000, would be allocated to the building. So the cost of the building would be 54,000. Do the same with the land. The land has a fair market value of 30,000. The total fair market value of all of the assets is 100,000. 30% of 90,000, the purchase price, the amount that would be allocated to the land is 27,000. And then finally, the land improvements. Their fair market value is 10,000 over the 100,000 total fair market value of all three assets. 10% of what we paid for them, 90,000, will be allocated to the land improvements. So when you add the cost that you determined, it should equal the purchase price you spent on these assets. So the journal entry would be debit building, 54,000, debit land, 27,000, debit land improvements, three separate assets for 9,000, and then credit cash or however they paid for those assets. We call this a lump sum purchase, when a company purchases more than one asset at one time for one price. All right, so we saw how we figure out the cost of an asset. So that's the first part of its life, right? And we saw all those different items that could be involved in it. Now, once we have the asset recorded and we start using it, now we have to start expensing it. We talked about this concept of depreciation back in chapter 3, and we said depreciation is the expensing of the cost of a plant asset over its useful life. And we're going to add one more little thing, to its residual or salvage value. So that's the definition. One more time. Depreciation is the expensing of a plant asset, the cost of it, over the time we're going to use it, its useful life, to its salvage value. We also say residual, which means what we think we could sell it for when we're finished using it. Now, how do we calculate depreciation? Well, here are three different methods you have to choose from, and there's actually more, okay? But in Accounting 111, we try to keep it calm, and we only show you three of them. So again, depreciation is the process of expensing, allocating the cost of a plant's asset to expense in the accounting periods benefiting from its use. So in the balance sheet, we keep track of the unused cost. It's called book value. Cost, and you should be jotting this down, minus accumulated depreciation. Remember the contra account? That gives us its book value, or the unused cost. The income statement is where we report the amount of expense we calculate this year. Now, in order to calculate depreciation, you need to know three things. You need to know how much the asset cost you. Well, we showed you how to figure that out a few slides ago. You need to know its salvage value, which is an estimate determined by the company. How do you know you're right? You don't. It's reasonableness. So an auditor would look and say, yeah, you're probably about right. So, auditors are going to use ranges if you have salvage values to see if you're pretty much on the mark. Useful life is also an estimate determined by the company. So I could go in and buy a car for my company. You can go in to the same car lot, buy the same car, pay the same amount of money, the same day and time I did. I could drive mine back to my company and say, its useful life is 5 years. You could drive yours back and say, its useful life is 3 years. We're both right. It's based on what we think we're going to use it. That's how it works in financial accounting. It needs to be reasonable, though. I can't drive it back and go, I'm going to use this for 30 years. No, you're not, right? So it's important that the company stays reasonable, but they estimate that. So we're going to look at the three methods, because once you know the cost, the company comes up with the estimated life and estimated salvage value, we could calculate. So two of the items are definitely given to you, because you can't read a company's mind and you can't read the author's mind of this book. Now we're going to show you the three different calculations. The first being straight line, and we saw that a little bit already in chapter 3. 90% of companies use this method, maybe more for financial statement purposes. It's pretty straightforward, easy to calculate, and very predictable into the future. But there's two other methods, units of production and declining balance. So we're going to look at all three. Declining balance is more popular for tax returns. And I have seen units of production when I worked at the trucking company. We use that method sometimes to depreciate our tractors. All right, so we have an asset here, whatever it may be. We'll say it's a truck, okay? The cost of it was $10,000. The salvage value, the company estimates to be $1,000. Now here's something important, and you should jot this down. The book value, cost minus accumulated depreciation. One more time, book value is cost minus accumulated depreciation. That amount can never be less than the salvage value expected for the asset. So the book value can never be less than salvage value. Salvage value is what you expect to get at the end of the life of this asset. So the book value should equal it when you're finished expensing this asset. And by the way, we say here cost minus salvage value. So before I go to the next thing I was about to say, the cost minus the salvage value is the most you can expense of this, right? $9,000. We call that depreciable cost. The useful life is 5 years. Now remember, that's an estimate. So I don't want you to think that when 5 years is up, someone's coming in, like the depreciation police are coming in going, we're done using this, 5 years are up. No, you keep using it. Keep using it until you can't use it anymore. The company wants to replace it. You just stop calculating depreciation expense. You estimated wrong. So what? You were close. Another way to define life is in terms of some usage of the particular item. So I can't really say, this looks like it should be machinery, right? It looks like this machine was purchased for $10,000 and it makes shoes. And so this, another way they define the life of this asset is the units of inspected shoes. So this thing should produce 36,000 shoes, this piece of equipment. If it was a truck, it could be miles. If it was a machine, it could be hours. So you could define the life of certain assets in other ways other than years. So let's see how this all drives together. Straight line depreciation is all based on a formula. You take the cost of the asset minus its salvage value. So you first calculate that. Then divide it by the useful life in periods. The total useful life. That doesn't change from year to year to year. No, it has a 5-year life. Okay? The cost doesn't change. The salvage value isn't changing. Not in our class for now. So take 10,000 minus 1,000, 9 grand, divide by 5 years. So under straight line, this machine will be expensed $1,800 each year. And it doesn't change. You don't have to calculate it again. Once you calculate a full year's depreciation, that's the dollar amount for the next 5 years. So each year when you're doing your adjusting journal entry, you'll debit depreciation expense, credit accumulated depreciation machinery for the $1,800. This method gets its name because if you graph this over 5 years, it's $1,800 each year. It would make a straight line. See, we're not fancy in accounting. Now take a look. And, oh, there's my graph, right? See the depreciation expense? It's $1,800 each year. So if those were dots instead of a bar graph, if we just put dots and drew a straight line, they would all connect. It doesn't slope at all, straight. Now remember, each year we debit depreciation expense and credit accumulated depreciation. At the end of year 1, our accumulated depreciation is $1,800. This balance sheet presentation you see in front of you is what would be reported at the end of year 2. At the end of year 2, we would have had last year $1,800, and we would have added another $1,800 to the accumulated depreciation at the end of year 2. So we would have $3,600. So on the balance sheet, remember we'll put machinery as the cost, 10 grand, less the accumulated depreciation balance. The difference is $6,400. That's the book value. This graph you see on to the right is it's showing you each year your book value goes down. In 2018, when this asset was purchased on January 1 or at the very end of January 2018, the book value was $10,000 because there was no accumulated depreciation. But at the end of 2019, you recorded $1,800, so now it has an $8,200 book value. And there's our end of year 2. See the book value on the 6,400 and 6,400 on the graph. And that book value will keep decreasing, and at the end of year 5, look at book value equals salvage value. Book value, one more time, is what you see in front of you, cost minus accumulated depreciation for that asset. So here's a schedule, and you're not required to make this beautiful schedule. Everybody does it differently, and now we have computers that calculate this for us. But we need to know how to do it because we didn't know what the heck the computers are doing, right? So each year we're going to be taking 1/5 or 20% of the asset's cost, because we're dividing that by 5, the depreciable cost minus salvage value, $1,800. And you could see how the accumulated depreciation account will keep increasing. Why? Because we're increasing it for $1,800 at the end of each year when we record that year's depreciation expense. And then you'll see every year the book value decreases because we're adding more in accumulated, subtracting a higher amount from our cost, book value will keep decreasing. So at the end, book value equals salvage value. And that automatically happens with straight line because we subtract salvage value from the cost and only depreciate $9,000. Straight line. Now let's look at units of production. It's a two-step process. The first thing we do, first of all, units of production is we depreciate on the use of the asset in terms of some unit of usage. This machine's usage is defined in terms of the number of shoes it will produce. It could be the number of miles you drive if it's a vehicle. It could be the number of hours you use a machinery for, if you could track the machine's hours. So not all assets can use this method. But if you have an asset that you can measure its use in terms of some unit of usage, then you do it if you want. So the first step is calculate how much depreciation there is for each time a unit happens, each mile you drive, each pair of shoes you make, each hour it's used. And how we do that is we take the cost of the asset minus its salvage value. And then we divide it by the number of units in total we expect to use it. And that'll tell us how much depreciation expense there is for each unit of use. Now to calculate depreciation, and once you do step one, you're done. You don't have to calculate that again. In the first year, calculate it, you're done. Step two happens every year now. You take your depreciation per unit from step one and multiply that by the actual number of units in that period. How many miles did you drive this year? How many shoes did it make this year? And that will equal your depreciation expense for that particular year. So coming back to the machinery, here's the cost minus the salvage value is $9,000. The company expects to make 36,000 pairs of shoes in total with this machine. So the life of the machine is 36,000 shoes. So each time a pair of shoes is made, this depreciates or should be expensed 25 cents. So now we need to track how many shoes were made in the first year. 7,000. So you would need to know that. Take the 25 cents you just calculated times the actual shoes made, 7,000, and that's the amount of depreciation expense for year one. So you will do this calculation each year for the number of shoes made that year, but you always must keep track of how many you've already expensed for, because you stop recording depreciation on this once you've accounted for 36,000 shoes. So assume in this slide that in year two they made 8,000 pairs of shoes. 25 cents a shoe, the amount of depreciation expense would be 2,000. You would debit depreciation expense, credit accumulated depreciation for the 2,000. Now your accumulated is up to $37.50. You still find book value the same way. Cost minus the accumulated depreciation at the end of that year. 10,000 minus $37.50, book value is $62.50. And you could see year five, or I'm sorry, the fifth year, which is just coincidental. So they might have made 36,000 pairs of shoes by the end of year four. They're not defining the life in terms of years. They're defining it in terms of use. But once they make 36,000 shoes, they stop calculating depreciation after they recorded depreciation for 36,000 shoes. Okay? And you could see at the end of the life, $9,000 was expensed of the machinery. Cost minus 9,000 accumulated depreciation gives us our book value, which equals salvage value. Just a different approach to calculating the dollar amount to put in the journal entry. The final method, declining balance. It's actually 3 steps for declining balance. The first thing you do is calculate what we call the straight line rate. And how you do that is you could take the number 1 or 100% divided by 5. Well, the life, I'm sorry, there's the formula. Straight line rate equals 100% divided by the useful life, 20%. Now, when I teach this, I teach steps 1 and 2 together. If you're calculating double declining balance, that means twice, just put 2 over the useful life, 2 over 5, and it'll give you 40%. Okay, so following your author though, double declining balance rate is 2 times the straight line rate, or 40%. Once you calculate that 40%, it remains fixed or constant over the life of the asset. So how do you calculate depreciation expense each year? You take the beginning period book value. So the beginning of the year, how much is cost minus accumulated depreciation? The book value. And then multiply it by that double declining balance rate you determined in step 2, the 40%. So each year, the book value will change. We've seen that already. As we add more depreciation into the accumulated depreciation account, our book value goes down. So why are they using $10,000 here? Why shouldn't they use $9,000? Because we don't subtract salvage value out anywhere in any of these formulas for declining balance. So it's very important that we're always watching to make sure our book value is never less than salvage value. This year, the first year, the cost of the machine is $10,000. There is no accumulated depreciation as of the beginning of 2019. So 40% times 10,000. 10,000 is the book value, or $4,000. Now let's see how this keeps going. So the beginning of the period book value is 10,000. The depreciation rate is always 40%. We call that the double declining balance rate. There's your first year's depreciation. Now you will have a balance in accumulated depreciation. Remember, because you're still when you make your journal entry, you're going to use 4,000. Debit depreciation expense, credit the accumulated depreciation. Now the book value will be cost 10,000 minus the balance in accumulated depreciation of 4. Now your book value is at 6,000. It is this new book value you will use to calculate year 2's depreciation. So going into 2020, 6,000 times 40% depreciation expense is $2,400. So in year 2, you'll debit depreciation expense, credit accumulated depreciation for that amount, $2,400. When you credit the accumulated depreciation, it now increases from $4,000 up to $6,400. Book value at the end of year 2 will be $10,000 minus $6,400, or $3,600. Now so far we have only have $6,400 in accumulated depreciation, and our book value is at $3,600. Remember that book value cannot get less than $1,000, the salvage value. Going into year 3, 3,600 times 40% gives us depreciation expense in year 3 of $1,440. That's the amount we'll use in our journal entry. That will cause our accumulated depreciation to increase $1,440 to $7,840. Book value now will be the $10,000 minus $7,840, $2,160. So we're still above $1,000. Going into the next year, use that new book value of $2,160 times 40%. That gives us depreciation expense of $864. That will be the amount we put in our journal entry. When we make that journal entry, it's going to increase accumulated depreciation from $7,840 up to $8,704. Now our book value is at $1,296. Cost $10,000 minus the accumulated depreciation of $8,704. Now going into year 5, if we take $1,296 times 40%, that will give us depreciation of $518. If we record $518, if we add that to the $8,704 that's already existing in the accumulated depreciation, our accumulated depreciation balance will be $9,222. Subtract that from the cost to get the book value. That would cause our book value to be $778. Not allowed. Book value can never be less than salvage value. So in a year that this happens, we go, ooh, if we calculate that dollar amount, it's going to be too much. Well, how much can I report? Well, your current book value is $12.96. The lowest it can be is $1,000, so $296. So we would debit depreciation expense and credit the accumulated $296 in that last year. That would cause our accumulated balance to be at $9,000. Cost 10 minus 9, book value equals salvage value. So in this method, you have to watch. Am I recording too much? How will you know? Your book value is less than salvage value. And in the year that this occurs, you stop. You record as much as you can to the point your salvage value and book value equal, and then you stop. And that's how double declining balance works. So what method do you use? Well, as I said, I was a little off. 85% of companies use straight line. 4% use declining balance. 5% use units of production. And 6% use some other method that we didn't talk about but are out there that can be used. So these are your most common. That's why we look at them. 94% of companies use these. So in the end, no matter which method you use, you're only expensing $9,000. It's just when you expense it is different. So straight line, you see it's the same amount every year. Units of production, it's based on your actual usage. So the more you use it, the more expense there will be. Double declining balance, there's a real lot of expense when the asset is newer. See, $4,000 in that first year, then $2,400. You've just about expensed the whole thing in the first 2 or 3 years. And then it's very low near the end. And the justification for that is when an asset is very new, you use it a lot. So it produces a lot of revenue. So you don't mind matching up the expenses at a higher rate than you would straight line. Then as the asset gets older, you use it less to produce revenue, and then your expenses would be less. But any of these methods is acceptable. And it's just like inventory. Once you pick a method, you stick with it. Now, when it comes to taxes, and I'm not going to spend a real lot of time on this, taxes is different than financial accounting. You can use straight line to calculate depreciation expense to report on your financial statements. And you may use a different method called modified accelerated cost recovery, which is really double declining balance for your taxes. Okay, and if you go, you can do that? Yes, you can. You can use 2 different methods for 2 different reasons. And that's all I have to say about that. Now, what happens if we have this thing partial years? We assumed in our example when we did all of our calculation that the machinery was purchased January 1 or in the beginning of January 2019. But that's not how assets are always purchased. When a plant asset is purchased or sold during the year, you have to calculate depreciation only for the fraction of the year the asset is owned. So you don't take 12 months of depreciation if you've only used it for 3 months. Here's our machinery again. And let's use straight line to illustrate this. We would take the cost of the machine minus the salvage value divided by the life. That gives us 1 year's worth of straight line depreciation. But now we're assuming we bought this on October 1st. So in 2018, you're not going to be allowed a full 12 months, but 3 of 12 months because you only used it for 3 of the 12 months. So in that first year and the last year or a year you sell it, you only calculate depreciation for the time period you actually used it. I mentioned before, when you estimate a life or estimate the salvage value, you stick with it, assuming you don't change it. So what happens is sometimes over the life of an asset, remember you're deciding on day 1, how long am I going to use this and what's it going to be worth at the end? Well, things change. New information may come to light that indicate you were wrong with your original estimates. So the question is, can you change them? Yes. You could change useful life and you could change salvage value. They're estimates. But you can't just change from straight line to double declining balance. That's an accounting principle. So how do you change an estimate? Let's look at our machinery from the previous examples. Assume that at the beginning of the asset's third year, so on 1/1 of year 3, the book value, cost minus accumulated depreciation, the company's using straight line, is $6,400. At that time, it determined that the machinery will only have a remaining useful life of 4 years. Originally, they thought the total life would be 5 years. Well, at the beginning of year 3, they go, no, we're going to use this for 4 more years. And the salvage value is only going to be $400, not $1,000. What we do on the day we make that change is we recalculate depreciation going forward. We let depreciation go as it was, and we just make changes based on these new revised estimates. What do we depreciate though? The book value as of the date of the change. So the new quote cost for our calculation for straight line will be the book value as of the beginning of 1/1, $6,400. We subtract the new salvage value of $400, and then we divide it by the remaining life of 4 years. Now for the next 4 years, our depreciation expense will be $1,500 per year. So just worry about this change in estimate for straight line. We're not getting super duper complicated here. We just want to let you know that sometimes we have to calculate depreciation for a partial year, and if our life and or our salvage value we feel need to be revised, we can going forward using this formula. Okay, I'm not getting all crazy with this either. This is more of an advanced subject, but sometimes an asset loses a lot of value very quickly, and it's permanent. A permanent decline in the fair value of a plant asset, of any asset really, requires the asset to be written down to its fair value. So what we do is, it's really a couple-step process, but basically we say this. What's the fair value of the asset? $3,000. What's the current book value of that asset? So if we sold this, we would get $3,000, but we still have $3,050 to expense of that asset because that's its book value. Whenever the fair value is below the book value, there's an impairment. Okay, so we do go through some tests and all. We're just showing you that if an asset does lose value, we record it as a loss, and that's how we do it. Worry about that more for a multiple choice maybe question. So what's the difference between this thing called revenue and capital expenditures, and how do we account for them? Well, revenue expenditure is an expenditure on a plant asset that does not materially or significantly increase the plant asset's life or capabilities. It's recorded as an expense and reported in the income statement. So you can look at these as more normal expenditures to keep the asset up and running properly, like an oil change for a vehicle, painting of a building, lubrication of equipment. Capital expenditures are expenditures for that asset that do provide for a longer life and benefit more than just the current period. These are actually debited to the asset account and are part of the cost of the asset. Things like getting a new transmission in the car, putting an addition onto the building, okay? A major part replacement in your machinery. So these are things that they're not part of the normal upkeep. They're going to extend the life of the asset, and they're going to benefit you more than one year, one accounting period. So ordinary repairs, we would debit maybe maintenance expense. We call them revenue expenditures because we match them against revenue. So maintains our normal operating, doesn't increase our productivity, doesn't extend the life any longer. Betterments and extraordinary repairs are capital expenditures, and that just means they're debited to the asset. Major overhauls or partial replacement extends the life beyond the original estimate. So you would have to define that by what the expenditure is doing and then record it accordingly. So ordinary repairs, again, debit repairs expense, credit cash. Even if they're a significant dollar amount, it still may be ordinary. Doesn't extend the life. And in betterment or improvement that will extend the life of that machine, debit to machinery. The final phase of an asset is its life is when we dispose of it or discard or sell it. So on the date that an asset is disposed of, so it's either sold or thrown out, we first must update depreciation from the last day we recorded it through the date of disposal. Then, and we of course make a journal entry for it, then we make a journal entry for the actual disposal. So what we do is, depending on how it's disposed of, we first, if it's sold, debit cash for the amount we receive. Then we will remove the asset that was sold. We credit the cost of the asset to that particular asset account. So if we sold machinery, we would credit the account for its cost. We would debit the accumulated depreciation related to that asset. You got to remove any depreciation that's in that account that you've accumulated over time because you no longer own that asset. And then the difference would either be recorded as a gain or a loss. So when you sell an asset for more than its book value, cost minus accumulated depreciation, you sell it at a gain. You made money. If you sell it for less than its book value, you sell it at a loss. So remember what book value is. It's the amount of the asset that's considered unused. So if you sell it for less than the amount you still have to use of it, you didn't recoup all the money. So you have a loss on it. So we're going to take a look at that. That's just a flow chart of how it works. So again, if cash is greater than book value, BV, cost minus accumulated depreciation, we record a gain. And a gain is treated the same as a revenue. Gains are on incidental sales, ones that happen once in a while. You sell an asset once in a while, but it's treated the same as revenue, and it's reported on the income statement, and it increases on the credit side. If the cash is less than the book value, you record a loss, and that's treated the same as an expense. Losses are on sales of assets that happen once in a while, and that's also reported on the income statement, but it decreases like an expense does. If cash equals book value, well, there is no gain or loss. You sold it for the unused portion. So a machine costing $9,000 with accumulated depreciation of $9,000 was thrown away. It wasn't sold. We didn't receive any cash. We just threw it away. The company's depreciating the equipment using the straight line method over 5 years or 8 years with zero salvage value. So they expensed the entire cost of that machine. Credit the machinery for $9,000, the amount of the cost, to remove it out of the asset account, debit the related accumulated depreciation for $9,000 because that's the amount that has been taken of depreciation on that machinery so far. So we decrease both accounts, and now we've removed a discarded asset that's fully depreciated. What if it wasn't fully depreciated? What if equipment costing $800 with accumulated depreciation of $6,000 as of 12/31 of the previous year was discarded on 7/1? The company is using straight line depreciation over 8 years, no salvage value. Well, the first thing we would have to do, remember, is update depreciation from January 1 of the current year through July 1 of the current year, because we've been using that but have not recorded any depreciation expense yet. So $8,000 cost minus 0 salvage value divided by 8 years would give us $1,000 depreciation each year. Now multiply that by 6/12 because we've used it 6 months of the current year. Debit depreciation expense, update the accumulated depreciation equipment account for that $500. So now the balance of your accumulated depreciation is $6,500. If they throw this asset away, credit equipment for the full cost of $8,000. Debit the accumulated depreciation for the full amount of depreciation taken so far. Since they still had $1,500 of book value left of this asset and they just threw it away, this is considered a loss on disposal of equipment. So they got 0 cash, but a $1,500 book value. So loss on disposal of equipment would be debited. And that, like I said, is like an expense account. It's reported on the income statement in other revenue and expenses. The very last section of our income statement that we talked about in Chapter 5. What if we sell the asset? So now BTO is going to sell an asset on March 31st that originally cost $16,000. It has accumulated depreciation taken on it already of $12,000 as of 12/31 of the prior year. They use straight line depreciation, $4,000 per year is the amount. The equipment is sold for $3,000 cash. Well, the first thing they're going to do is update depreciation expense to record the amount of depreciation from January 1 through March 31st of the current year. So $4,000 is for entire 12 months. They need to record 3 months, so 3/12 of $4,000 would be $1,000. So as of March 31st, debit depreciation expense and increase the accumulated depreciation equipment another $1,000. When they sell this asset for $3,000, they're going to debit cash for $3,000. But what's the current book value? The cost is $16,000. The accumulated depreciation is $13,000. So they sold it for its book value. So there is no gain or loss. We'll just credit the equipment for the original cost and debit the accumulated depreciation related to the equipment, $13,000. But what happens when they sell it now for $7,000? Same information. First, update the depreciation for the depreciation expense related to January 1 to the date of the sale. We're going to credit the equipment for the full cost, debit the accumulated depreciation for the full amount of depreciation taken on this equipment. Debit the cash. So the cash received is $7,000. The book value is $3,000. So this was sold at a gain. So we credit the account gain on disposal of equipment for $4,000. What happens if we sell it for less than its book value? One more time, same information. First, that depreciation expense must be updated for the current year. Then we debit cash $2,500. Again, credit the equipment for the cost of $16,000. Debit the accumulated depreciation equipment for the full amount of depreciation taken on this equipment. We're removing those two items. The $3,000 book value is more than the cash that we sold it for. So when you sell it for less than its book value, you have a loss on disposal for the difference. So we would debit that loss on disposal of equipment. Again, it's treated the same way as an expense, goes on the income statement, and this would be reported in the other revenue and expense area, just like the gain. And you could take a look back at Chapter 5's income statement to see that. Okay, so that concludes our discussion on plant assets, determining the cost, determining the depreciation amount, looking at a couple different methods, straight line, units of production, and declining balance, accounting for expenditures on that asset after we purchase it. Are they capital or revenue? And then what happens when we dispose of that asset? The journal entries related to that. I don't spend a lot of time on the next item because it's for unique industries, but I'm going to run through it a little bit. It's natural resources. And it's usually done on a units of production method. Take a look. A mineral deposit with an estimated 250,000 tons of ore is purchased for $500,000 and is expected to be mined and have no value at the end. So how do we expense the mining of this ore? Well, we calculate depletion per unit. We take the cost minus the salvage value of the mine, divide it by how much we expect to mine out of it, 250,000 tons. So every time we mine 1 ton, there's depletion of $2. So each year we'll take that depletion per unit, the $2, times the units extracted out of the mine. How many tons were taken out this year? 85,000 is the dollar amount, or the number they gave us, 85,000 tons times $2. So we would deplete or expense 170,000 of the mine's cost. So we would debit depletion expense and credit accumulated depletion, which is a contra account, to our mineral deposit asset. And just like we do with plant assets, we'll take the mineral deposit cost of $500,000 and subtract the accumulated depreciation balance. What happens when there's some ore, so the mineral remains unsold at the end of the year? Because remember, as you're mining this, you're selling it. You're not like stockpiling it, right? So what we would do is, if we don't sell all the ore that we mined, we would still credit accumulated depletion, 170,000, but we would only debit depletion expense for the part of the ore that was sold. The remaining amount, and this was just given, the assumption is there's so many tons of ore left times $2, the ore inventory asset would be debited for that amount. Sometimes we have special assets that are used to extract the natural resource. Maybe there's, heavy equipment of some kind. These assets are recorded just like other plant assets and depreciated normally. So that's just a little flavor for what this depletion is. Like I said, unless you work in a specialized industry that is using it, you probably won't see it. I've never seen it myself in the real world. Sorry, I started recording this yesterday and now it's morning and I'm finishing it up. So if you've noticed me sniffling a lot and stuff, I apologize. The final asset we're going to talk about, we have 2 or 3 slides on, are intangible assets. So what's an intangible asset? So it's an asset that lacks physical form. And you could think of it as legal rights. It's non-current. It provides exclusive rights or privileges. And you can either create it or purchase it. You usually have it for operational use. And sometimes it's difficult to determine how long you're going to use it. Here are some examples. Patents, which protect an invention. Copyrights, which are a protection of artistic creations. So if you own a patent, only you can profit from that invention. If you own a copyright, only you can profit from that artistic creation. Franchises and licenses. So franchises gives the person who purchases this franchise right the exclusive use of another company's entire business. Licenses give permission to use a part of another company's business. And really quick, I'll tell you a story. Years and years ago, Hershey Company was thinking about selling their stock. The trust that owns it, the family, they were thinking about selling it. And people in Hershey, Pennsylvania were going crazy because they were fearing that a large candy company would buy the company and split it all up, and basically Hershey Company would dissolve. At the time, and they still do, Hershey deals with Nestle, and Nestle said to Hershey, you better give us first dibs on buying your stock or we're going to pull our licensing agreement. So I kept reading, what do they mean, the licensing agreement here? And here, Nestle allows Hershey to use one of their recipes to make a product that they created or own in the United States. Now remember, this was 15, 20 years ago. I think it was in the mid-90s actually. And what happens is Nestle doesn't feel like purchasing and building a facility here to make this particular item in the United States. So they say, you make it in the United States, Hershey, you distribute it and send us some of the revenue you make. And that item is the Kit Kat bar. So whenever you get a Kit Kat bar the next time, take a look. It's made by Hershey, licensed through Nestle. So that could have been a huge impact to Nestle or to Hershey Company. It ended up, it never came to fruition, so Hershey's still making it. But that's what a licensing agreement is. Trademarks and trade names, they protect symbols. Something called goodwill, which I'll talk about in a little bit more. Leasehold improvements, don't worry about these are a little too advanced. Research and development, and other intangibles. So I like to focus on those first 4 or 5. What do we debit the asset for? What we paid for it. So if you purchase one of these from somebody who already has one, you debit an asset. This purchase price, any legal fees. So if you're the creator of the item that would be patented, copyrighted, or trademarked, usually the only amount you have in an asset account is how much you pay your attorney and your filing fees to create the actual patent. During your research and development, you expense all of those costs. You don't know if you're going to create anything. So the FASB says expense research and development. But if you purchase this, or if you have to pay a lawyer to help you with the process at any part or have filing fees, that's the amount you would debit the intangible asset for. Okay, so self-created, you're not having a lot in this account, but if you purchase it, you will. Okay, so the final intangible asset that I want to talk about a little bit more detail is called goodwill. And it's important we understand what goodwill is in the context of a company. This is not Salvation Army, okay? And it's the company that's buying that will have goodwill. So always keep that in mind, buying. And I don't have it on the slide here because I created this really quick because there was no explanation of goodwill in the slides, but you want to note this. It's when one company purchases another company. So that's when goodwill will result. And what happens? It's when the selling price or the amount the company is paying for the other company is greater than the fair market value of the assets minus the liabilities of the company they're buying. We call that net assets. One more time. So maybe you could change that, even not selling price, but the purchase price. It means the same thing, but we're doing this from the buyer's perspective. So it's when the buyer pays more than what the assets minus liabilities are worth. So I always use an example of, think of companies that the product, when you think of a product, you just say the name of the company, like tissues. People just go Kleenex. And if I also say, name a company when I give you a product, and I'll say soup, and people go Campbell's. Ketchup, and they say Heinz. And 99.9% of the time, I usually get that response with Heinz. So let's pretend we're Heinz company. Now Heinz does a lot more than ketchup. Let's just keep it simple. Let's say Heinz company, you're looking to buy it. So you are the company looking to buy Heinz. So you're not green when it comes to this kind of stuff. I got to find out what it's worth in terms of, if I buy all the assets of the company and buy the liabilities, because that's what you buy when you buy a company, their assets and their liabilities. What am I really buying? So you have an appraiser, or an appraisal is done, and you find out the fair market value of the assets minus the liabilities that are on the company's balance sheet is $225,000. But you're willing to pay $300,000. So the purchaser is willing to pay more than they're actually getting in fair market value of assets minus liabilities. That's called goodwill. And here's what it represents. When I say ketchup and everybody says Heinz, that's called product recognition. That's a generational thing, especially when it comes to ketchup. So people in the ketchup market are probably going to buy Heinz ketchup over another brand. That is an awesome thing for a company to have. They don't have to do a lot of promotion and advertising. They're already known. Also, Heinz has a huge percentage of the market when it comes to ketchup. If you think of ketchup being a pizza pie, they probably have 90%, if not more, of that pizza already in customers. They have a huge customer base, and as I said, it's generational. My grandmother used Heinz, my mother used Heinz, I used Heinz. If my kid used ketchup, he would use Heinz. Okay, so that is big when you're buying another company. You don't have to look for the customers. Maybe Heinz has a great employee base with a long-standing employees that have worked there 15, 20, 30 years. When you have new employees, they don't know the company, and they're not very, they don't care if they have to stay or leave. But when you have long-term employees, they're more willing to stay. They know the company. There's not a lot of training. They have an allegiance to the company. That's important. So these are really intangible things associated with the company that aren't on the balance sheet of Heinz ketchup, but you are willing to pay $75,000 for them. That's what goodwill is. It's when the purchaser is paying more for the company than, looking at it's worth, because the profitability of this company is there. So, but I don't want you to think you walk in and say, I know your company's only worth $225, but I'll pay you $300. Now, it's a negotiation process, right? They know, Heinz also knows they have these great intangible items that aren't measured yet and aren't on their balance sheet because nobody else has measured them for them. And remember, if Heinz was given the ability to measure this, they would say it's worth millions and millions of dollars because they created it. They need someone independent to come in and measure that. And that's what you do when you pay more for it than its fair market value of the net assets. So when you see goodwill on a company's balance sheet as an intangible asset, and you will, especially large companies, that means they paid more for that company that they purchased than the net assets were worth. Okay, so a little part of Chapter 10 talks about expensing. And I don't have a slide on this, but just know that certain intangible assets are expensed, just like natural resources are, and just like plant assets are. And they're usually expensed straight line. And we call that expensing amortization. So they each have their own unique name to describe expensing. So we looked at the entire life cycle of a plant asset. We touched on natural resources and now amortization. So that wraps up your Accounting 111 discussion. Hopefully we'll be seeing you next semester. Please post any questions you may have to the discussion board.